In this video, I want to highlight why municipal bonds can be riskier than you think. They can be risky at times. So here are disadvantages of municipal bonds. Number one is a lower yield. There's that inherent lower yield associated with municipal bonds. Municipal bonds are typically offer lower yield compared to corporate bonds or other higher risk investments, making them less attractive for investors who are looking for higher returns. If you want to accumulate higher returns over time, then I wouldn't advise you go for municipal bonds because of the lower yield they offer. Number two is interest rate sensitivity. Interest rate sensitivity. Like all fixed income securities, municipal bonds are subject to interest rate risk. If an interest rate rises, the market value of existing bonds will fall, potentially resulting in capital loss for investors who may want to sell before maturity. Because of that inverse relationship between interest rate and bond yield, that discrepancy tends to present risk to bondholders. Number three is credit risk. While generally considered lower risk, municipal bonds are not risk-free. They're not totally risk-free. Of course, no investment is totally risk-free. No investment is 100% risk-free. So if the issuer faces financial difficulties, then such as a city or a state experiencing fiscal challenges, the bonds may default or suffer credit downgrades, affecting their value and interest payments. In a case where the issuer, the state government or local government is experiencing financial difficulties, then the rating agency would lower the rating on their bonds, which would get them downgraded, and that will affect the overall par value of the bond and even the coupon they are likely to pay out. Number four is taxable for higher income earners in certain states. While municipal bonds may offer tax exemption, some states and local taxes may still apply. Generally they have that tax exemption kind of dynamics, but yet some of them could still be taxed, especially if the bonds are issued outside of the investor's state of residence. If the investor is residing outside the states that issued the bond, then the person concerned will be taxed appropriately. So higher income earners may also face limitation, on tax exempt benefit due to the changes in tax law. Those who are in the higher tax brackets may not benefit from this tax exemption mechanism when it comes to municipal bond investing. Number five is liquidity risk. Liquidity risk. So in this case, municipal bonds can be less liquid than the U.S. Treasury bonds or corporate bonds. That is it. Compared to, bond issued by the federal government, that liquidity is always a concern, especially in smaller or less traded issues. This can make it harder to buy or sell bonds quickly at a favorable price. If you access the trading platform of a given brokerage house and you go to the bond section, you discover that you hardly come across sufficient liquidity in bonds. You have sellers, you may not have buyers. You have buyers, you may not have sellers. So that liquidity challenge is a major concern when it comes to bond investing. Number 6 is call risk. Call risk. Because many municipal bonds are callable, meaning the issuer can redeem them before maturity. So it's a risk on its own. So typically when there's a decline in interest rate, the issuer may decide to redeem the bonds. This can result in reinvestment risk, where the investors may be forced to reinvest the principal at a lower yield. So when the bond is called and you want to reinvest, you are doing so at a lower risk. Number 7 is economic and political risk. Economic as well as political risk. Municipal bonds are subject to economic and political conditions of the issuing region. If the region is politically unstable, there's an unrest or riot or instability, that will invariably affect the bond. It's a major concern, in an economic downturn, in political instability, this will negatively impact the ability of the issuer, the local government, the state government, the municipalities to meet their obligations to the issuer, to their investor rather. Please like this video and subscribe to this channel so that I can be motivated to keep on pushing out contents of this nature to you. Number 9 is complexity in tax treatment. While the tax exempt status of municipal bonds is attractive, tax laws around these bonds can be a bit complicated. For example, some income from municipal bonds may be subject to alternative minimum tax, and the tax treatment may differ based on the type of bonds. Example, general obligation bonds. You have revenue bonds. So all these nature of bonds will affect the applicable tax treatments. Number 10 is limited diversification. Limited diversification. So if an investor focuses heavily on municipal bonds, they may limit their exposure to other sectors or type of investment, potentially missing out on higher returns or diversification from other asset class. So it's a major concern actually because of the opportunity cost involved. So considering these disadvantages, you need to think very hard. You need to think critically before you think of investing in municipal bonds.